This is now starting. All attendees are in listen-only mode.
Try that again. I've been talking and clicking buttons, everyone. Good afternoon. Thanks for joining me on this wonderful St. Patty's Day. Happy St. Patrick's Day to you all. We already have a question, which is, we can hear you now. Thank you, Dr. Reimer. Looking forward to talking about financial statements. I know it's something near and dear to all of your hearts, and that probably we don't understand or use a lot. So today we're going to look at the three typical financial statements you'll have for your practice: your profit and loss statement or your income statement, your balance sheet, and then a very special statement called the cash flow statement that you may or may not need to look at. And so we'll talk about what is the content in each of these documents, these reports that you can generate for your practice, and then a couple things to be looking out for as we're looking at them. So first off, we're going to start with the profit and loss statement. We'll spend the most time there, more than likely, because it is the most important of the three for most optometry practices. And we'll actually do a quick poll to kick us off. And we'll give everyone just a minute. And close it out. So, about for those interested, 90% of the attendees here are reviewing their P&Ls monthly, which is great. Glad to hear it. And we'll jump right in. So when we look at the profit and loss statements, this is a basic format. I'm not putting numbers in today. I really just want to talk about what's there, and a little bit on the profit and loss statement as to how we use it. But a general format is going to flow something like this. And the profit and loss statement's job is to tell you about what kind of job the business is doing at generating income. What's the revenue coming in, and what are the expenses going out? We'll touch on this a little more in a minute, but do be aware that depending on how you do your accounting, whether you're on accrual method or a cash basis for your P&Ls, it may or may not match up exactly to what came into the bank in a given time period. For startup businesses and smaller businesses, cash basis can be nice because it's exactly based on cash in, cash out. For expenses, you know exactly where you are. For most of your practices, an accrual method is appropriate. An accrual means basically that we get to make a decision about when we count income as being realized or generated, and when we book expenses. So basically, because we have our insurance payments coming in arrears, 30, 60, 90 days later, and our bills being due for our materials cost in particular, at a delay, 30, 60, 90 days, it's nice to be able to book the revenues in for the time period they were generated that month, even if you haven't actually gotten paid for them yet, and also to tie back the cost of goods to when that was happening. But so most of you will be accrual. Email me if you have questions on that. It's probably my preferred method for most practices we work with. We'll start with a collected gross revenue number. And you'll remember, in one of the things in our reporting that we'll always ask for is what's the collected gross. That's net of insurance charge-offs, net of sales taxes. It's the money that actually came into the bank. So there is a wonderful higher number that might be, almost half, 50% higher than what you have on your P&L. That's what you're billing out. That number is a fiction. The number that matters is the money that came into the bank. After that, most profit and loss statements will have cost of goods and materials costs. And I prefer, I don't mandate this, it's up to you. I prefer to have cost of goods just be the materials cost. So spectacle lenses, frames, contact lenses, accessories. There are some people who will put their buying group dues in there, whether it be IDOC or Vision Source. Not my preference, but certainly that's an option, and there's good reasons to do that. A key thing as we look at this is I want to encourage all of you to make your financial statements work for you. So this is a format that I think can be very informative to reset up your charts of accounts and your categories for your expenses, so you don't just get a standard QuickBooks template that is very useful for some percentage of businesses, but isn't really tailored to an optometry practice. So we'll prefer to look at it this way. But again, materials cost I prefer, or cost of goods is just, I was clicking on that one, I didn't mean to. Prefer just your materials cost there. After that, after the gross profit number, which is what comes after just revenues less your materials costs, we have a bucket of expenses. This is roughly the 7 key expense areas that you'll have seen Dr. Jerry Hayes write about, Dr. Neil Gelmard write about, heard me talk about. But we have our wages, and one thing I would encourage you to do is break out your wages between non-OD staff and the employed ODs and the owner's payroll. So if you're paying yourself for being a doctor, if you're taking a salary, put yourself. The normal categories would be just salaries or staff. Doctors is usually how people will do it for the employed ODs, and officer for the owners. We'll have occupancy costs, equipment costs, marketing, and general office overhead. And this will lead us to an operating income number. That's a special number because there's some stuff that comes after it that I'd like to see you do in your P&Ls. But the operating income is basically what kind of income the practice generated for the time period based on its normal operations, which is, to me, basically seeing patients and selling them products. So professional fees and material sales. There's other things that are expenses that we want to recognize, things like depreciation and amortization, things like taxes. You might have meaningful use credits that, lovely $17,000 check or whatever it came out to. You may have outside income from working at nursing homes or prisons, or just taking another job. That's all very good. I want to make sure that we have a number that's reflective of just what the practice does. And there's usually a section under operating income. It's sometimes called ordinary income, called other income and expenses, and that's where I put those things. So your non-cash expenses like depreciation and amortization, they're there for tax purposes. They don't really reflect any money that you spent to depreciate your equipment. Taxes as well, and this would be income taxes primarily if you put them on the P&L. And then other income sources as well would go there. And that'll come to a net income. Important thing to know is that as we go back from the bottom to the top, all the net income and the expenses will add up to the collected gross revenue at some level. So those will all reconcile. As we look, I don't want to go a lot into expense management here. I really want to talk about the statements. But again, you'll have seen this graph before, I think, from us. But we always think for an optometry practice, a pretty standard allocation of expenses would be about half the revenues are going to be spent on cost of goods and staff. That mix can vary depending on what kind of practice you run. A more medical practice will carry more staff costs. A more traditional practice will carry more cost of goods in terms of products being sold. But typically, that'll be 50% or less. And we call it between 55% and 45% of revenues, something like that. There will be fixed overhead, which you have to spend just to open your doors and run the business. Typically, that's about 20% of revenues. Things in fixed overhead would be, most of it's going to be your occupancy cost, so what it costs to be in your space, and general office overhead, which if you're wondering where to put stuff, that's where it goes generally. But that's your Prima Eye Group dues, your accountant, the software for your practice, the paper you use, insurance expenses for the business. Fixed expenses will also include any leases on equipment you have and whatever marketing spend you have for your practice. Those two are usually quite small, but they fall in that fixed overhead number. And then on average, it's probably a little less than this now, but prototypically a practice will net, and we define practice net in this circumstance as all the pay to all the doctors and the corporate profits, about 30% of its revenues. Couple notes on the P&L. One, do bear in mind, if depending on a cash basis versus accrual basis accounting, that the net income showing on your P&L may not be what hit the bank. Also note that net income and take-home pay are two different things. Even when we put owner benefits back into a net income number, if we're putting things like your health insurance back in, your auto allowance back in, just because the practice showed you netted, let's be aggressive, 100,000 for the quarter, that doesn't mean that there was 100,000 available for you to spend on a really nice car for that quarter. And again, I think it's very important to set up your P&L so it tells you what a single line of business or a single location is doing. So one thing I strongly encourage any of you with multiple offices to do is to run separate books for each of your locations. It doesn't mean that you have to set up different tax IDs and run separate income tax statements for them and tax prep, but it does mean that you have a sense of the revenues and expenses tied to each location so you know how they're doing, especially if you have one main office and several smaller offices. And even if you don't, there will always be some commingling of expenses, but it's very helpful to know, particularly if you needed to sell off one location. If you've commingled your expenses, there's no way to even necessarily come up with a realistic price and justify the price to a buyer. So very, very helpful to separate things. Other practices will do things like often vision therapy will be run on a separate P&L. Often that is actually incorporated separately for third-party reasons. But do make sure that the P&L is reflective of one line of business. A couple other notes. And there's a typo in here, but break out your payroll taxes and benefits and do both. Allocate the expenses tied to people between the officers, the owners, doctors, and then on your staff. That income tax should be sales tax. I'm sorry for that. Sales tax comes out before total collected revenue. So oftentimes you'll have up here, this is simplified, but a lot of times you'll have a revenue section that has total billed to insurance charge-off, sales tax, discounts offered to customers before we get to a collected gross revenue number. So do put sales tax there. It tends to throw things off if it drops into the expense area of the P&L. If it's down here, it'll often get dropped in general office overhead. It tends to confuse issues if it's there. And again, outside income, like a meaningful use credit, goes after your ordinary income or your operating income. I will stop and give you 20 seconds to ask questions if you have any. And otherwise, we will charge right ahead. I think everyone should turn on their webcams. Let's see who's wearing green today. All right. Well, everyone does a great job of reviewing their P&Ls, which I appreciate. But now we're going to jump into the balance sheet. So there's a question about the copy of the slides. We can absolutely get that to you, no problem at all. Quick poll, how often are you reviewing your balance sheets? All right. And interesting. I mean, a number of you are reviewing them regularly. A follow-up question I don't have here is how many of you understand them? But glad to see that. Let's talk about what's on there. So a balance sheet is designed, if an income statement reflects a period of time, a month, a quarter, a year, a balance sheet is actually a single moment in time. It's going to be dated December 31, 2015, June 30, 2016. And it is a snapshot of one day. It reflects the assets and the liabilities and equity of the practice. So what does the practice have in terms of either cash in the bank or equipment it owns? What does it owe? And then by definition, assets less liabilities equals the equity of the business. And again, I'm not going to go into double entry accounting and how to track things here. The purpose today is more just to understand what's on there. But if we're looking at our balance sheet, and I'll note before we jump into that, actually, there's usually not a lot on your balance sheets, and that's okay. Optometry practices aren't capital intensive. Inventories aren't huge. It's really just your eyeglasses and contact lenses that you're selling. And again, dispensaries carrying what they do, that's a pretty known number, usually something between, say, $70,000 and $120,000 worth of inventory, which is a lot of money, but not, relative to your revenues, not a ton. And it tends to turn fairly quickly. So there's not going to be a lot on your balance sheets. And what I want to do is just review what's on there, what does it mean, and a couple of red flags. So we'll have our assets, and we have two types of assets and liabilities. We have current assets and not fixed assets or non-current assets, and we have current liabilities and non-current liabilities, or long-term liabilities. The assets, basically, the current assets are things that can be turned into cash within a year. So things like the cash in the bank or any savings accounts we have, your inventory, which can be liquidated quickly, even if it doesn't. Accounts receivable falls into current assets. We expect to receive that money well within a year. We'll also have long-term assets like your property and equipment, so equipment that you own, leasehold improvements that you've done to your space, and that'll be less any accumulated depreciation or amortization on your goodwill usually. And that'll give you a total assets number. And then the second half of the balance sheet is going to be liabilities in the owner's equity or equity. Again, current liabilities is pretty straightforward. Accounts payable, your credit cards, any current income taxes that are due. Long-term liabilities will be loans outstanding on equipment. Sometimes it's categorized as leases. There can be loans to or from the shareholder in there. And again, usually the balance sheets are pretty clean. You'll have some for your equipment, but normally there's not a whole lot in here. And then again, assets less liabilities comes to equity. And in the equity section, what we'll have a record of the distributions that you've paid out, the invested capital that you put in, and then retained earnings or net income over time. So every year as you're journaling this, when you get to the end of the year, or what QuickBooks is probably doing for you, or your accountant, is the net income gets put in there, and then most of you haven't put money back into the practice since you bought it, which is fine. And then distributions are what's coming out. A couple things on the balance sheet, and most practices are pretty liquid, and I don't see this coming out. But if you want to do a quick check, a couple ratios you can check on your balance sheet. The quick ratio is just the ratio of current assets less inventory, so basically cash against current liabilities, and it just gives you a sense of what's your ability to retire your current debts. Current ratio is similar, probably not as applicable. I'd use the quick ratio for optometry practices, but current assets against current liabilities. Those are liquidity ratios, and they just tell us if we're worried about our ability to cash flow well, what the ability of the practice is to pay its debts that are owed within a year. Two things to look out for on your balance sheets when you're reviewing them. One is, and it's probably more common than I'd expect, but if you have shareholder loans, either to the owner or from the owner, on your balance sheet, I would make sure you understand what that is, and clarify with your accountant what's the path to clearing those off. Just make sure there's a plan to repay them and retire them off. I was reading recently that if those things show up on on your balance sheet in a situation with litigation. If it looks too much like you're commingling personal finances and your practice finances, and that's one of the red flags for that, a case can be made to go beyond the practice assets into your personal assets if there was a judgment against you. So just be aware of that. And the other one for all of you owners of S Corps, if you go into a negative equity situation where you've taken out more money from the practice than the practice has earned, that can be a taxable event in and of itself as if you sold the practice. So we have had Prima members have to put money back into the practice to shore up their balance sheets at the end of the year for tax purposes. So just be aware of that, you'll have probably, many of you have heard me encourage you to take as much money out of the practice as possible. I want you to do that, but there is such a thing as taking out too much money. And that's oftentimes, if you feel like your cash flow is tight, you may be pushing into that. There's a lot of reasons that cash flow could tighten up, but that's one of them. So let me stop again and ask if there's any questions on the balance sheet. I'm actually very impressed at the nearly half of you that were checking it monthly. So I'm glad to hear it. One other note that I'll make, if we think about cash flow in particular, one of the things to know is that your income statement only reflects the expenses tied to the practice, but there's some things involving debt where, from an accounting standpoint, the only debt payments that show up on your income statement, your P&L, are the interest payments on a loan, and any principal payments on a piece of equipment are actually reflected as a reduction in the long-term liabilities. So interest is usually a smaller part of that loan. Sometimes the practice will look more profitable than it is because the P&L only shows, or it looks like it should have more cash than it does, because the P&L only shows the interest payments, and the principal payments on loans shows up on the balance sheet. And that will actually take us on to a cash flow statement, which marries the two up. And if you have tight cash flow, this is something that is a great thing to be reviewing. So let's see if any of you at all, looking forward to this answer, review your cash flow statements from your CPAs. And that's trending more where I would have expected it. So over half never look at a cash flow statement. That's fine, by the way. I think they're helpful, but only when cash flow is an issue. Monthly review of it is great, particularly if you have a startup practice, or if you've got a lot of debt that you're retiring. I think it's helpful to take a look at it. Have a request to speak slower since people don't understand. We'll hide those results. So cash flow statement is going to marry up the information from the P&L and the balance sheet, and it's going to tell you over a period of time what the change in cash has been from the business. Cash is king, and again, most practices don't struggle with cash flow. Your practices, just structurally, there's not a lot of debt normally, and there's a lot of revenue coming in for the vast majority of you. But here's the cash flow statement we'll do. It's going to define the change in cash in the practice in three areas. The first would be from operating activities, and this again is from the P&L. So depending on how your P&L is structured, it's going to take the net income, it's going to put back in the depreciation and amortization that you showed, and then it's going to net out any changes in loans from the shareholders or increases or decreases in accounts payable. So again, and then it's going to tell you what is the change in cash provided by operating activities. And again, the reason we're adjusting out depreciation and amortization is those are non-cash expenses that we track, at least in the States, for tax purposes, that it can count against your income and lower your tax liabilities. Then we'll have cash flows from investing activities. Effectively, if you paid cash for a piece of equipment, that will show up here. If you sold a piece of equipment, that will show up here. And again, investing activities, that's basically what's going to be there for an optometry practice. And finally, we're going to have the change in cash from financing activities. When you borrow money from the bank, it's actually going to increase your cash. So borrowing money helps cash flow. When you retire debt, it reduces cash flow. And so this is where those principal payments will show up for the practice. And then if you put any money back in, that's going to show up here. Again, we're talking about the business, not your personal finances. So if you put money back in, it's going to show up as a positive to the cash flow. Any retained earnings that you didn't take out of the practice from your net income will show up, and then any distributions back to the shareholders will come out. And again, if cash is an issue, if you have debt that you're trying to maintain, I would highly encourage you to talk to your CPA about generating a cash flow statement on a regular basis to see what the changes are. This is if we're talking in a consult and I'm telling you the practice looks very profitable and you're telling me there's no money, this is the type of analysis that needs to be done to reconcile that. And we've done this with multi-million-dollar practices that were struggling with cash flow, because even though the money was there and even the P&L looked pretty good, there were debt obligations that were eating into their profitability, their ability to pay themselves. So very useful for the practice that's struggling with tight cash flow or feeling like it's difficult to pay the bills. And a really good one to look at. At the end of the day, most of you own S corps, which means that the business income is your personal income. The practice value, hopefully you've heard me say before, is really in the cash flow you can take out. So I want you taking out as much income as you can from the practice. This is a good way to have a feel for what's available. And oftentimes, even in partnerships, there will be language in the operating agreement that says that the value when a partner is ready to sell is going to be calculated based on the cash flow to the equity partners. That's how important this one is. So it's important in the sense that it's probably the truest reflection of what's available in your practice. For most of you that I work with, there's not enough debt in the practice to really need to go here. Usually the P&L is pretty close to what the actual cash flow of the practice is. So that cash flow from operating activities is all, because there's really not much going on in terms of investing activities, and whatever cash flow comes from financing activities is really just the retained earnings, the net income flowing into the equity account, and then distributions coming out. And I will stop and take any questions on that. Actually, that's out of order. Nope. Any questions on the cash flow statements, or I'll come to the end and make 3 quick points and take any additional questions, and we can go from there. So a couple takeaways. One, glad to see you reviewing them. Hopefully this helps you know what's going on in your financial statements. I do highly, highly, highly encourage you, and call me if you want help on this. Make sure that your financial statements are tailored to your needs, that you understand what they mean, you know how to use them. If you have multiple offices, please keep separate books for all the locations. It's very king. And again, cash is king. If you're having trouble paying bills in your practice, or you feel like there's not enough income to pay yourself based on what your P&L says, it's a great time to talk to your accountant about, or just run it out of QuickBooks, but run a cash flow statement. So I will stop and ask for any additional questions, and thank you for your time. And here's a gratuitous pic of my family from last summer. Oh, there they come. All right. Well, thank you all very much for joining me. I'll remind you at any time, if you have questions, I am happy to review your financial statements with you. Happy to look them over. I'm not a CPA, but I'm happy to talk to your CPAs. And please let us know how we can help at any time. Thanks so much, and have a great afternoon.